This industry is collapsing. I'm your host, Steve Metre, and thanks for joining me today. In our show today, this entire industry is crashing at the fastest rate since the global financial crisis, and I want you to understand that it has dire consequences for the entire economy. And this is coming at a time where everyone now is throwing in the towel. They actually believe that the Fed has engineered the impossible, that we're actually going to have a soft landing without a recession. And this sector, this part of the economy, is saying that that is not going to happen at all. Plus, we have a sponsor for today's show. We have a cybersecurity company who says its clients some of the highest level in the government. We want to show you why we think their stock is a bargain and could be traded for a 30 to 70% return. Well, please stay tuned to the end of the show or check out the pinned comment or description for more information. Now, if you're wondering what we're doing in the warehouse of America's and the world's largest online retailer, well, hang tight, has everything to do with our story. Let's go to the Wall Street Journal. We picked today's story up with the headline, Federal Reserve raises interest rates to 22-year high. And all of this is a confidence vote by the Fed that says, look, we think the economy is super hot here. We have continued to raise rates, and it is so good that no matter what we do, it's not slowing down. And all of a sudden, you're seeing everybody look around and say, look, the stock market's up, the labor market's doing just fine, inflation's coming down. Well, somehow, some way, they've done it, and that's become now the main story here. But we're going to show you just in a bit why all of this narrative by the Fed is going to come crumbling down. Powell didn't rule out another rate hike at the central bank September meeting, but he emphasized how much central bank had already done with the amount of time it can take for monetary policy to cool inflation. He says we've come a long way. Inflation repeatedly has proved stronger than we and other forecasters have expected. We're ready to follow the data, and given how far we're come, we can afford to let this unfold. And all he's saying here is, look, monetary policy has nothing to do with inflation. There's no relationship, there's no correlation, because if there was, then something would have happened by now. But what we do know is between now and the next FOMC meeting, we're going to see two data series. There's going to be two monthly reports. We're going to have two CPI reports. We're going to have two of everything. So there's a case now that if everything comes down enough, that perhaps the Fed will go to a pause. But this is where the market starts to buy into the fact that maybe the Fed did pull off the impossible. Powell also said the Fed's influential staff no longer was forecasting a recession to begin this year as they had in March, May, and June. Instead, it was projecting a noticeable slowdown in growth. So here we can see already that, hey, he's saying, look, recession off the table. It's almost as if he got pulled aside to the principal's office and got told, hey, you know what? You need to stop telling the American public and the world we're going to have a recession, because if they start to believe it, they're going to cut their spending. Well, we're going to show you a little bit that maybe that's already started. But of course, now we see Fed Chair Powell say, look, we're just going to have a bit of a slowdown here. It's not going to be an all recession unless it is. A few Fed officials have suggested they might prefer to raise rates again at the central bank's September meeting, while one has endorsed a longer pause. Others who think the impact of the Fed's rate increases have yet to take full effect are more likely to favor waiting till November or December to decide whether another increase will be appropriate. And of course, we can go back to the prior meeting where we heard, or the meetings before, where the Fed says, look, they're baking into the cake 2 rate hikes this year. That puts November or even December as the next possibility, if for one of the very few times in history the Fed actually holds true to its projections. But something that came out today that says, look, the economy may be doing just fine, is another lagging report that the market loved. U.S. GDP growth accelerates to 2.4%. This moved higher, blowing past estimates. But is this going to last? Well, I'm going to show you it's not. The U.S. economy is in better shape than economists had expected it would be just a few months ago. While forecasters are split on the odds of a recession, a strong labor market, sturdy consumer spending, and now easing inflation have fueled hopes that the U.S. will avoid a downturn, even though history suggests that when you see a move down in consumer prices, there's almost always a recession that follows. There's almost always an increase in unemployment that follows. But I'm going to show you why this move in the GDP report is one we're going to look back and say, well, that was a one-off print. Growth is outpacing expectations even as monetary policy stances become restrictive, unless it's not restrictive at all. A strong household sector that continues to benefit from positive job growth and rising real incomes, that's inflation-adjusted incomes, should keep growth on positive trajectory this year, or at least that's the hope. Because when we take a look at real gross domestic product, and we've got that in blue, shown here on a year-over-year rate of change, and this is a really lagging report, and this is what everyone's excited about. This little move higher right here has gotten everyone believing that perhaps we're on the cusp of engineering that soft landing that the Fed is so excited about. And nevertheless, we can look back going into prior recessions and we can see, well, it has moved higher. And we can see here again, we can see these back, in fact, almost in front of every recession. But what we've got overlaid in red is the current general activity index for the Philly Fed manufacturing sector. What I want you to see is the red line leads the blue line lower. So even when the blue line is moving up or not coming down as quickly, what it suggests here is this is just another attempt by the governments with their lag data to say, look, everything's okay, even though underneath we can see all the signs, all the macro data that tells us perhaps things aren't as good as we thought. But then we got another report today saying that, well, maybe things are really this good, but perhaps that doesn't tell the full story either. Here we head over to Zero Hedge with the headlines. Durable goods orders in June saw the biggest monthly spike in 3 years. Again, durable goods suggesting, things like washers and dryers, big ticket items that people are back on the buying mode, and they're expected to rise for the fourth straight month, but it blew out to the upside at 4.7% month over month, 4 times the expected increase, which is the biggest monthly increase in durable goods since July of 2020. So at face value, says, well, wait a minute here. If the Fed's got this pulled off, maybe the GDP report is actually right. And look at these durable goods orders suggesting the economy is much likely here to rebound. But it's underneath that report that we see that maybe it's just the Boeing effect. Excluding transportation, orders climbed only 0.6%, which is still pretty good, which makes sense given 69.6% surge in non-defense, this would be Boeing, aircraft orders, and that surged higher, driving, of course, the tape up. And what we can see is when we look at manufacturers' new orders, we're going to keep that Philly Fed General Activity Index in red as our baseline for today, and we're going to look at this against manufacturers' new orders in blue. I'm going to give you 2 looks at this. One is without any change to the data, you can see that generally the two go together, which makes sense. The regional Fed reports actually seem to get the picture ahead of time, notably seeing how the red line leads the blue line to the downside and to the upside. Here we can see something doesn't make sense. Either these factory surveys coming out of the regional Fed are actually completely wrong, or the government's cooking the books. But when we change the blue line to a year-over-year rate of change, what we can see is this little bump higher here is almost meaningless in the data series. We can see the regional Fed data still pointing to a downturn, suggesting that even though the government data may be a little optimistic here, the trend is to the downside, and whatever's happening with Boeing in terms of all its new orders for its jets are actually going to be transitory in the bigger picture of the data series. But who else is on board with this? Well, crude oil. As oil rallies above $80 as the U.S. economy grows more than expected and now hopes that things are going to get better, well, oil driving higher as it's broadly rallied since late June, aided by supply cuts from OPEC and its allies and signs that Russian seaborne crude exports are falling. But higher fuel prices are likely to add to a renewed inflationary impetus, which will show you is not true to the global economy when finally someone gets it right, with gasoline surging around the world. So far you get the case that maybe everything is absolutely great, and I'm going to show you that why is this one industry crashing, and this industry, when you look at it, says, wait a minute, not everything is as good as this data appears. But when we do look at inflation expectations, we can see the consumer price index in blue on a year-over-year rate of change against U.S. regular oil formations gas prices. This little move higher on a year-over-year rate of change in gas does not really tell us that inflation is going to come surging back at all. In fact, it just tells us that perhaps as inflation comes down with the lag, that it will moderate a little bit. But here we can see in the headline story, as the worst cardboard box recession since 2008 could be a sign of broader economic weakness. Now you think about this, and I want you to frame this from the discretionary side of the economy. When people order goods online, hence why we're in the warehouse of Amazon, again, the world's largest online retailer, because they ship a lot of boxes. So if they're not shipping as many boxes because demand for those is down, what does that tell us about the discretionary side of the economy? It tells us it's in a lot more trouble than the economic data suggests. But a rather upbeat indicator has been signaling a level of economic weakness not seen since the global financial crisis of 2008 and 9, and that's the shipments of cardboard boxes. Packaging Corp of America, the number 3 containerboard company in the U.S., reported this week that sales of cardboard boxes fell a whopping 9.8% from last quarter from a year earlier, in one of the biggest slumps on record. That added to a 12.7% plunge during the first quarter. The combined 6-month decline is the biggest since early 2009, according to FreightWaves. So here we can see the consumer side of the economy, the discretionary side, which we need to grow the economy, to put demand out there, to keep people employed, is slowing down in a big way. Now, some of you might be asking us, why hasn't this hit the economy yet? Well, we're seeing a slowdown here. You got to remember, not too long ago, we saw employers lay off a fair amount of people. They've kind of pulled back because guess what? Everyone's believing in the Fed now. They believe in the soft landing narrative. They believe that we're going to see a second half rebound. And the data, while starting to suggest it is, so the real data underneath says not a chance at all. The thinking goes that cardboard boxes can act as a barometer for the health of this economy, since they play such a crucial role in transporting of goods, not just to consumers who buy things online, but to stores and warehouses that receive those goods in bulk. That means that if demand for cardboard is slowing, consumers are buying less stuff, and that's exactly what inflation is telling us. We see the slowdown in inflation or disinflation, and what it's telling us is demand is coming down, and we're getting validation from that from cardboard boxes of all places. So the idea here that we're going to see some second half rebound, well, if that was true at all, what we should be hearing from these cardboard box manufacturers say, hey, you know what? First quarter was pretty bad. The second quarter, well, that wasn't that good either, but hold tight. We're seeing a whole bunch of new orders flood in here, and everything's going to be a-okay. But instead, we're not seeing that at all. And what we're actually seeing is employers still holding on to employees in the belief that everything is going to turn around. And sure enough, that manifested itself in the weekly unemployment claims data that have now fallen to 221,000. We can see last week we mentioned on a non-seasonally adjusted basis, they were at 258. Well, the government now says on a non-seasonally adjusted basis, dropped 44,000 last week. So everything seems to be normalizing and showing us that employers are still willing to hold on. In fact, some of them are even hiring, as we see weekly continuing claims drop down below 1.7 million to 1.69 million. But what doesn't make a whole lot of sense here compared to the rest of the report is we look at total claims now. We see up 165,000 last week to a total of 1.9 million. Now, what I can tell you here on a local level is we have a lot of employment that goes on here in the vacation capital of the world. It's my opinion is we overhired here, and talking to a lot of the hourly staff, they say, look, there's not a lot of opportunity. There's too many of us, not enough hours. And some of them going out looking for all of their work are telling me, I can't find anything right now. And it's pretty unusual. But what this all suggests is we're likely to see more layoffs than not. And here we can look at, again, coming back to that general business activity for the Philly Fed, overlaying the 4-week moving average initial claims. So everyone's hopeful here that we're going to see a big turnaround in the economy, but we can see at any time that you see big drops in this Philly Fed index in blue. It's eventually balanced off by an increase on the 4-week moving average of initial claims, suggesting that even though we're seeing claims pull back down here to kind of the low 200,000s, that the show is not over yet at all. In fact, that suggests that perhaps we're going to see kind of a second half, not surge in inflation, but a surge in disinflation and an increase in unemployment, and that spells bad news for the economy. But one thing we are bullish on is our sponsor for today's show. I want to introduce you to Plurilock AI. Now you can find them online at plurilock.com and on the OTC, trade them on the PLC KF. Well, we have all of that data in the description, pinned comment below, where you can find them on the U.S. exchange and on the Canadian exchanges. And they're a least privileged cybersecurity solutions company. And I want to show you why we think their stock is a bargain right now at its current price, and just how it could be traded to perhaps 30 to 70% upside from where it is today. But let me show you a little bit more about Plurilock, and then we'll get into the opportunity. Plurilock is a cybersecurity consolidator in North America with a unique IP in digital identity and anomaly detection. They have a world-class team with decades of experience in managing cyber threats. They have unique capabilities. They're deeply connected in the commercial and government space, as you'll see here in a little bit, and they've got a strong platform for mergers and acquisition growth. I mean, these folks are masters at actually getting great acquisitions and turning them around into profitable position. Here we can see they're trading on the TSXV under PLUR and on the OTCQB at PLCKF. And they have technology driven, as their platform for least privilege access control includes their Plurilock AI Cloud, a single sign-on least privilege access control and cloud data safety program. They've got Plurilock AI Cloud DLP, which is cloud and endpoint data loss prevention and web filtering. And they've got Plurilock AI Complete, which includes SSO, CASB, and DLP capabilities informed by real-time defend identity. You put that all together, you've got SSO, CSB, DLP, AID, and that is the Plurilock least privilege access uses all together, and puts together a fantastic product that is solutions driven. And here you can see, looking at their solutions division, they have a track record of successful acquisitions and integrations. They've brought on Aurora, Integra, and Atreon, and they are all profitable. This is a great track record. Again, look them up on the OTC, PLCKF, and they list some of the biggest names in the government and commercial space as their client. Here you can see they've got clients in the national security and defense sector, federal and civilian, state and local, and commercial. Check them out. They are the biggest name that you may not have ever heard of. And looking at their capital structure, one thing we can note is that as of April 28th this year, they had $2.7 million in cash. So what's nice about this isn't a company that's looking to raise cash. They have cash. They're looking to raise awareness of their stock and see it trade higher. It's currently trading, as we record this, around 10 cents a share. And they just had a major announcement. Let me check this out. Plurilock AI ranked as top cloud access security broker software by Infotech Research. Here we can see that has ranked their flagship platform, Plurilock AI, as a top cloud access security broker software. According to Infotech's rankings, Plurilock AI was ranked first among leading software solutions, including Microsoft Defender for Cloud Apps, Prisma Cloud, Cisco Cloud Lock, and Oracle Cloud Access Security Broker. In addition, Plurilock AI was rated as a leader in terms of product features, in satisfaction and vendor experience and capabilities. So one thing we think they're going to be a leader in next is where their stock price is headed. Again, you can find them on the TSXV under Plur, on the OTC under PLCKF. Let's take a look at their long-range stock picture here, because you see they got the volume profile turned on. Momentum's kind of just running sideways on the RSI. We see the same thing here on the MACD. But what's really notable here is they have a tremendous amount of volume support at 9 cents a share, making this one of the easiest stocks to buy because it's so inexpensive, putting a lot of potential upside. Let's take a look and zoom in here, because we can see here on the 6-month window, plenty of volume support at 11 cents a share. And again, at the time of recording, it was trading right somewhere between 10 and 11 cents. Where do we think the upside is? Well, take a look at this. We notice at 13 cents, it seems to be where the next big chunk of volume is, where sellers are at. That's a roughly 30% upside. You see if it pops back up here to where a 6-month high, there's your potential 70% return. Let's zoom in once again, because here you can see on the 90-day chart, you see a tremendous amount of volume support here. We're seeing just a bit of a pullback in momentum, and that's where we think from there, we think Plurilock stock could take off. As with any stock featured on our show, you're under no obligations to purchase it. Before you do, make sure you do your own research. We've got all the information to help you with that in the description and the pinned comment below. Remember, PLUR on the TXSV and PLCKF on the OTC. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.